If you're self-employed and you've tried to buy a home in the past and you've been turned down because once you provide your tax returns, the bank sees your write-offs, I'm going to tell you about a loan program that will completely change the game for you as far as real estate is concerned. If you've never seen my channel before, my name is Aaron Page, your next lender, and I've been a mortgage loan officer for almost 15 years. One of the biggest struggles that I've always encountered with self-employed borrowers is that they like write-offs on their tax returns. It's one of the main benefits of being self-employed. The problem with this, though, is when a traditional bank looks at your tax returns and you only show that you made $90,000 but you wrote off $85,000, they see that you made about $5,000 net and they use that as your monthly income over 12 months. Well, simple math will tell you $5,000 annually divided by 12 is not going to give you very much money per month in order for your ratios to support a new house payment. In this scenario, we would turn to one of our two options when it comes to self-employed borrowers and getting them into a home. The first one, and the most popular one that my team and I see all the time, is called a bank statement loan. Now, a bank statement loan works like this. You give me 3, 6, 12, or 24 months of bank statements, whichever is strongest. We then look at those bank statements and we add up all of the deposits over the time frame that you choose. So the most common is 12 months. That's what we do probably 99% of the time. So let's use that as our example. You give me 12 months of bank statements. I add up all of the deposits over that time frame, and then we multiply that figure by an expense factor to give you your annual income. So here's a hypothetical situation of how this would work. I take 12 months of bank statements, add up all of the deposits over that 12-month window, and let's say that number comes to $100,000. I'm then going to take that $100,000 and the fairly standard expense factor that we deduct out, because we do assume that nobody works for straight profit. That doesn't typically exist, is 25%. We take $100,000 times 25%, which would bring us down with a deduction of $25,000 to $75,000. We then take $75,000 and divide it by 12 months, and that will give us our monthly income figure for you in qualifying for a home loan. So the numbers will tell you in this situation, $75,000 divided by 12 comes out to $6,250 a month. That's the income we're going to use for you on your file. And on this program specifically, we don't even get tax returns. We don't even want to look at them. We don't see them, nothing. Just bank statements, and we divide out your income, and that's how we come up with your usable monthly income figure in that scenario. The second option, it's not as common, but it is definitely doable. It's called a P&L loan, which profit and loss loan. Is how that works is you have to have a CPA for this scenario. Your CPA will create a profit and loss statement. They will audit it, they will sign it, and then you send that to me. I then go off of your gross revenue minus the deductions that the CPA has laid out on there. Whatever that bottom line net figure is after your expenses, we then divide that out by 12 and use that for a year-over-year profit and loss as your annual income. On this scenario, we're only looking at the last 12 months or the most recent year. So for right now, we would want to see essentially September of 2023 to September of 2024. We do want a 12-month window, but as you can see coming up with the new year, you have to update it every single month that it rolls. This method is certainly less paperwork, but the interest rates are not the same as if you did a bank statement loan. The bank statement loan is typically going to give you a more attractive interest rate, so most borrowers lean that way if you're already going in one of the creative financing lanes to go that route. The last and final piece on this, everyone always asks what the interest rate is. How much different is it? And I always kind of give a rule of thumb. You're not going to be looking at points of interest higher. Like as an example, if current conventional interest rates are down in the 6s, I'm not going to say anything specific because compliantly I can't. Let's just say they're in the 6s. You could assume with a bank statement loan, you're going to be very close to that. There is going to be some adjustments, but we normally see about a half a point higher in interest than the typical going rate during that time. So the main reason for me saying that is that you're not going to be, if an interest rate is in the 6s, you're not going to be in the 9s on this program. It's not like that would be predatory. So you're not going to be in a predatory interest rate range on these. They are just creative financing, so they're different than the conventional FHA or VA loan types that are out there, and they're specific to self-employed borrowers. If you guys have any questions or would like any additional clarity, please feel free to reach out to me. My contact information is in the description as well as all over my profile. I hope you guys enjoyed the video today and look for many more coming up. And also make sure you hit the subscribe button.